If you're looking to benefit from market exposure in your investment portfolio, but fear the potential risks associated with direct investment in stocks or mutual funds, then structured notes may be a good option for you. Principal at risk notes, or PARs, are investment solutions that effectively combine the protection and income potential of bonds with the growth potential of equities. One type of principal at risk note is the auto-callable buffer note. Auto-callable buffer notes are structured investment products that have the potential to provide a fixed return linked to the performance of a reference asset, while also providing contingent principal protection at maturity, or early call date based on the performance of the underlying reference asset. These notes have a call feature, whereby the note can be automatically called if the reference asset return is above the predetermined call threshold level on a valuation date. Typically, that's observed on an annual or semi-annual basis. If the note is not called prior to maturity, the investor's initial investment is fully protected, as long as that reference asset return is above the predetermined downside buffer level at maturity. There are a number of features associated with auto-callable buffer notes, so it's important you understand these potential benefits and risks before making an investment decision. Investors have the potential to outperform a direct investment in the reference asset under certain circumstances. Investors have the potential to receive their initial investment and a predetermined fixed return prior to the maturity date of the note. Investors have contingent principal protection at maturity. On the other hand, if the underlying asset performs poorly and decreases in value over the term of the investment, some of the original investment may be lost. As the possibility exists that a note may be called earlier than the scheduled maturity date, there's a risk that the market conditions at that time will dictate less favorable investment terms for reinvesting the proceeds from the note being called. Auto-callable buffer notes, like all principal at risk notes, are not eligible for CDIC insurance. With that said, let's go into a little more detail on how these notes actually work. The return of auto-callable buffer notes are typically based on the performance of equities or equity indices. The call feature of the notes is based on a predetermined call threshold. If the return or the reference asset is above the call threshold on a valuation date during the term of the note will be automatically called by CIBC, and investors will receive a predetermined return. The call threshold, returns, and valuation dates are all specified up front, so investors have full transparency on these product features. The contingent principal protection of notes is based on a predetermined downside buffer percentage. If at maturity, the return of the reference asset is negative, but is still at or above the downside buffer, investors will receive an amount equal to their initial investment. If at maturity, the return of the reference asset is negative and declined by more than the buffer percentage, investors will only lose the amount below the downside buffer percentage, multiplied by a specified participation factor. In these situations, investors will sustain a loss of a portion of their initial investment, but this feature means that they will lose less than a direct investment in the underlying reference asset. Let's walk through a few more detailed examples of how this actually works. So in this example, the performance of the reference asset is greater than or equal to the call threshold of 0% on a valuation date prior to maturity. So in this case, the note will be called, investors will be paid a predetermined fixed return plus a variable amount if the reference asset return is greater than the fixed return. In this example, the note was not called during the term. Investors will not receive a return on their note, but will be repaid their original investment even though the performance of the reference asset was negative. This is because performance of the reference asset is greater than the specified buffer percentage at maturity. In this example, the note was not called. Investors will receive less than their original investment at maturity because the return of the reference asset is negative and less than the specified buffer percentage. That being said, investors will lose 10% of their investment, even though the reference asset decreased by 20%. There are many auto-callable buffer notes to choose from and lots of great information available. CIBC Structured Notes. Increase your return potential, not your risk.